Hello, to the From Renter to Homeowner series. Last episode, we talked about what the bank tests you on, cheat codes. We know what the tests are. I'm going to give you the calculations. If you haven't downloaded the calculator, click the link below, sign up to the Resource Hub and download the calculator, and then you can have that open next to you while we do this episode. I'm actually going to teach you the manual calculations for this, but that calculator just does it all for you. So smarter, not harder. Otherwise, if you want to do manual labor, no. Otherwise, if you're someone who needs to learn the hows, which is what this episode's all about, otherwise I wouldn't even be doing it, we'll break it down. Okay, for this episode, what I thought we would do is we would use an example of a family's numbers. I'm making it up, but just so that we can run through the tests and apply it to numbers. And then you can do the same with your numbers, whether you do it the manual way and work it out or whether you use the calculator. As a starting point, we've got house price, which is $800, income of $170,000 gross, home loan of $680,000. There's other debt, so car, personal loan, credit card of $30K. And those are the numbers that we're going to work with for this family. Okay, test number 1, LVR. So for the LVR, it's loan divided by value. And for this scenario, we're just going to work with the value being the same as the price because those things can be different. But for the purpose of this example, $850,000 is the price and the value. So the $680,000 divided by the $850,000 times 100 equals 80%. So for the LVR, this family sits at 80%. Which is the pass point or the safe zone for the bank. A way to improve your LVR is the boring one, is borrowing a bit less. So that means that either you're asking to have the price a little bit less or you're looking at a cheaper house. You're not going to go with that one. Sorry, you're going to go find a cheaper house. Or you're going to increase your deposit so that you are borrowing less. So those are the ways to improve your LVR. Probably not exciting and magical, but those are options. Debt to income. Okay, so this family's income is $170,000 we worked out. Okay, so the debt that they're taking on is the home loan, which is $680,000 plus the $30,000 for the car loan, personal loan, and the credit card debt. And so that equals $710,000 total debt. So now we go $710,000 divided by the $170,000 equals 4.18, and the safe number for the bank is around 6 or less. So this family passes the DTI. Now, ways to improve your DTI. Obviously making more income. So whether you do some more overtime consistently, whether you ask for that pay rise that you should have gotten years ago, whether you go out into the job market, apply for a few roles, get an offer, and then you bring that offer back to your current employer and be like, hey, they want me over there. They're going to give me this amount of money. What can you do for me? Or you just go to that new job because it gives you more money. Or you do a side hustle. Please, just a side note, if you're looking at getting into your home in the next 2 years, don't go and start your own business and do that because the bank want to see a good record of how much your company can actually make. And that's usually about 2 years. So if you're going to do some extra work, do a side hustle for now, unless you want to wait 2 years, just so you know. Okay, so increasing your income so you have more borrowing power available to you, or decreasing your debt, obviously. Maybe you want to work towards paying off the credit card and the personal loan. That's another way of doing it. Or you look for a cheaper house. Again, that's another option. Going into debt servicing ratio. So in the calculator, you're going to add in all your expenses and the form will calculate what are fixed expenses, what are living costs, what's discretionary spending. Discretionary spending is just the things that you choose to spend your money on. You don't have to, but they're things that you want to spend your money on. So maybe you're someone that likes to get Uber Eats. That's a discretionary spend. So what are fixed costs? I'll just run through them quickly. Mortgage repayments, rates, car loans, daycare costs, personal loans, credit cards, any other agreement you have in place that you're locked into. That's a fixed expense. Okay, so let's look at DSR for this family. They have their new mortgage costs. So if we worked on 5% as the interest rate, so you add on the 2%, so a 7% interest rate will be applied over a 30-year mortgage term. Then we're looking at $4,525 a month. Then you got rates. car loan repayments, personal loan repayments, credit card repayments. So let's just work with $5,808 a month. So that's their total fixed costs. And then we're going to divide it into their monthly income. Their monthly household income, which is $14,167, and that equals 41%. Will they be approved? Maybe, maybe not. Not sure. So this might be a scenario where you're like, let's try and improve our situation. So how can you do that? Bringing down your debt repayments and your fixed costs. If you see stuff that you can actually pay off now so you don't have that as an expense, maybe that's something that you do. Again, none of this is financial advice. I'm just talking about what other people have done to improve their situation. Again, increasing your income or borrow less money again. Again, these aren't the most magical tricks and hacks. So we've done the debt servicing ratio, which also ticked off the stress test because we automatically applied the 2%. Now we come into account management and your relationship with money. We don't have a calculation. It's just about putting our best foot forward and presenting ourselves well. So account management, knowing what's going in and out of your account, making sure that you're not going into unarranged overdraft or that you're going into overdraft constantly, because that means you're borrowing from future you constantly. I'm sure future you is loving that. And it also tells the banks that you're not living within your means. So constantly living outside of what you actually earn. And so it's not a good look. Another way to look a bit prettier is to set up your account in a way that's functional for you. So maybe you have an account where your money goes into and all your expenses go out of that account. And then you've got a savings account, you've got a spending account, an emergency fund account, just different accounts. So the bank can be like, wow, this family really know what's going in and out of their accounts and they're organized and they're being responsible. Okay, so now we're going to do net surplus. We worked out that this family's fixed costs $108, but now we're going to look at the living expenses that they have and the discretionary spend that they deem as important that they can't give up when they're a new homeowner. So let's take our fixed expense cost, which is $5,808 we worked out, and let's just assume your living costs like groceries and stuff, and then your discretionary spend that you cannot give up equals $3,000. So we're working with $10,800. We're going to deduct it from
net monthly income. So if we just assume that one person made 80,000 and the other made 90,000, and we looked at them after deductions. So for the 80,000, it would be 4,960 per month, and for the 90,000, it would be 5,474, totaling 10,434 net monthly income.
And that leaves them with 1,626 worked out as a weekly amount, because that helps my head a little bit, is 375 rounded. So having that left over a week is pretty decent, really. And I'd say that the bank is comfortable with that. Because remember, we've used the stress test rate as well. So the 2% higher for mortgage repayments. So if that number was lower, you just want to look into your finances, look at your bank statements, look at all your expenses. Even if you look at that calculator where you spend all your information based on statements, go and have a look in that. That's an accurate way to look at what your expenses are. But look through all those expenses and see if there's anything that you're willing to give up, because that's going to increase your surplus. Or maybe you're like, actually, I'd like to give up a few things so I can invest as well, or I can make additional payments to my mortgage and invest, or create a bigger emergency fund, or whatever it is. So this will be a great exercise to just see where the heck is your money going? And are you okay with that? Are you okay with it going here? I bet you that probably there's a couple subscriptions that you signed up for that free week and they're just ongoing. And that company is like, thank you very much for your money. So don't let them win. You go and have a look through your bank statements and make sure you're not giving away money to things that you're not even using. And then we have your relationship with money. And simple ways to display that you have a great relationship with money: knowing what money is coming in, what's going out, knowing what you're spending your money on. So all these things that you're doing anyway. Making payments on time. If you have an arranged overdraft, it does not need to be in the thousands and thousands. Bring that baby down. Learn to live within your means. Some families have it around $200. Again, not financial advice. Do what you like. Even better, if you can remove the overdraft, if you don't even need it, that means that you're living within your means. So that's a goodie too. Consistent savings, paying bills on time, even if you can make additional payments, that's going to look even better. So these are small things that you can do to prove that you have a great relationship with money. Just a good way to start is knowing what's going on with your money. And if you're applying as a couple, both of you need to know what's going on. Because I know in a lot of relationships, there's one person that handles the finances, which is fine, that's all good. But make sure you both know what's happening. You both know money going in, coming in, and money going out. You both know roughly where your money's going to and how much the rates are, insurance and stuff. And then the bank will say, wow, look at this couple. They both know what's going on. They're a team. That's going to be even better for them to see. So that was the bank's tests broken down. I've given you the calculation, but you can go ahead, download the free resource in my free resource hub. Click the link below and it'll work all the numbers out for you. The next episode, we will look at the application form and we'll just go through it. What do these words mean on the paper? What does that even mean? How do I find that number? Where do I get that? What is an asset? So I'll break it down for you. I'll catch you at the next episode. Ka kite anō.